Hi guys, Max here, and it is of course your daily market update for yesterday, the 6th of July. And as you can see from this heat map behind me, actually equities performed rather well for the day, with most sectors rising on the whole. Tech did rather well, with big mega cap tech companies like Google, Microsoft and Apple all rising by about 1% for the day. The one sector which did perform quite poorly was of course energy and oil companies, as you might imagine. The reason for this is really quite simple. Oil prices are still rather depressed. This, of course, being about the idea that if a worldwide recession comes along, then demand for oil is probably going to drop off a cliff. The S&P 500 then rose by 0.4% for the day, the Nasdaq rose by 0.6% for the day, and the Dow Jones rose by 0.2%. On the bad side of things for American equities, the Russell 2000, which is an index of much smaller companies, but the ones which actually make up most of the economy of the United States, well, those stocks fell by 0.8%, showing that there isn't much confidence in that sort of area. Now, across the rest of the world, it was rather mixed, to be honest. The FTSE 100 here in the UK rose by 1.2%, and the Stoxx 600 rose by 1.6%. But as you can see, China had an absolute nightmare, with most stocks falling by 5, 6, 7, some even as much as 10% for the day, as there is, of course, chaos with the Communist Party, making things uncertain for investors, as it will always be, because that's what communist parties do. Over in the Americas, it was rather mixed, and then the rest of Europe was okay as well. On the whole then, the MSCI World Index rose by 0.3% for the day. Now, the dollar spot index rose as the dollar continued to strengthen against almost all of its peers. The euro fell to below $1.02 each, to a brand new 20-year low for the currency. The pound fell to around about $1.21 to a 2-year low for the currency. And then the Japanese yen is still sitting at around about 136 yen per dollar, which is about a 30-year low for that currency. So really what we're seeing here is the dollar acting as a safe haven continuously throughout the entirety of 2022 so far, and people putting their money there from overseas because it's just slightly more reliable than every other currency right now. Now, in the bond markets, in fixed income assets, well, the US 10-year Treasury yield rose by 12 basis points to 2.93%, approaching that 3% mark again. Now, there's been a lot of talk about the bond markets right now, and they have been ridiculously volatile, so it is very hard to make sense of what's going on. There is a lot of talk around quantitative tightening as well, and the idea that the Federal Reserve was supposed to be selling off its balance sheet, reducing the assets that it holds, and that would include selling loads of fixed income assets like mortgage-backed securities. That would flood the market with supply, it would force prices down and yields up, and over the entirety of the last month, the Federal Reserve has basically just not sold any of their assets. They haven't reduced the size of their balance sheet really at all. The rumors are that the Fed is putting up MBS's mortgage-backed securities up for sale, but there are just no bids for them as there are no buyers. This is very weird. I'm not 100% sure what to make of it. I don't know how the Fed plan to continue to go this direction with quantitative tightening if there are literally no buyers. But this is likely one of the main reasons we've seen yields fall over the last couple of weeks instead of rise, as they may well have done had things been slightly different. Now, finally then, for commodities, WTI crude is sitting at about $98 a barrel, so still very low compared to where it's been over recent months. Brent crude is just a touch higher at $100 a barrel. Again, as I mentioned earlier, this is just in the idea that there's going to be less demand for oil into the future because of a worldwide recession. We haven't actually seen that reduced demand yet. This is just in anticipation of that. And then we've seen the price of gold fall very slightly again, down to $1,740 an ounce, which is the lowest it's been throughout 2022 so far. What's happening over in the crypto markets then? Well, as you can see, it's green, but only slightly green. And really, this is nothing spectacular. Bitcoin at $20,400, Ethereum close to $1,200, nothing really groundbreaking. We've seen these sort of levels over recent months, and so nothing's really changed here. We did get some news out from Celsius, who have announced that they have paid off the entirety of their Bitcoin loan, which means that it doesn't matter what happens to the price of Bitcoin, they will not be liquidated for that specific piece of debt. We don't know about the rest of the assets that they may have leverage against. And this, of course, doesn't solve their problems at all. They still don't have the money to pay back their customers, and that really isn't going to change either. Now, as for the news for yesterday, what was the big talking point? Well, it was, of course, the Federal Open Market Committee minutes that were released for the month prior. Basically, we get to see everything that was said in the meeting where Jerome Powell and co. decided to hike interest rates by 75 basis points. And so everyone's looking, scouring over what was said, trying to determine what's going to come into the future. And so markets are trying to price themselves accordingly as well. We did learn a few things. The first is that actually another 75 basis point hike is certainly possible. We might even see it this month itself. More on that in a moment. The Fed also indicated that they would actually be willing to be even more restrictive and even more aggressive if inflation continued to get worse. So if we see the CPI continue to skyrocket, if we see it at 9 or 10%, then the Fed could even opt for a 1% rate hike if they needed to. They are very worried about inflation becoming entrenched. So this idea that actually they can't bring it down by raising interest rates and we'd enter some weird sort of 1970-80 stagflation era, which is a big worry for a lot of people. We also then got a lot of anecdotal stuff, which was slightly positive in regards to what the Fed is hoping to achieve. They put forward anecdotal evidence suggesting that wage inflation has been decreasing, which is a good thing if you want to bring down inflation on the whole. They also put forward this idea that business investment is falling because businesses are a bit worried and so they're not investing into their futures quite as aggressively as they did before. And then they also put forward this idea that consumers are finally starting to spend less. If all of this comes out to be true, then this would be confirmation for the Federal Reserve that their actions are working, that these rate hikes are doing their intended jobs, and that inflation is finally on the down. As I said, though, this is anecdotal. There isn't real empirical data to support this idea yet. Now, in some bad news from this stuff, we heard that Powell hinted at this index of common inflation expectations being very important. Basically, it's a new way of measuring inflation that the Fed put into place a couple of years ago, and Powell put quite a lot of emphasis on it because it looks at about 20 different inflation measures, and it's supposed to show a rather big jump this month. And as Powell is paying close attention to that, that could be bad news for people who want a dovish Fed because it could mean another 75 basis point rate hike this month, or maybe even more past that as well. Now, the markets really aren't sure how to price this minutes meeting at all. It is rather hawkish, but they're not sure. Investors just aren't sure if this is good for their investments or bad for them. The idea, of course, being that in the short term, interest rate hikes are bad for business and bad for markets. But in the long term, if it works and it brings down inflation, then that will be good for markets and good for the economy and business. And no one really knows what direction to really lean at this point. We have the exact same thing with the US employment data that we'll be getting out on Friday. No one really knows what we want to see. A strong jobs report would suggest that the economy is strong, and normally that would be a good thing. But we're trying to tame inflation, so a strong jobs report should be bad, so it should be a bad thing. I've seen a few people come out and say that they genuinely don't know what they want to see, and I think I'm in the same sort of boat here. It seems that every single piece of news that we get has the potential to be bad. Now, just a quick bit of news regarding the British Prime Minister and politics here in the UK. This is a finance channel, so we will just briefly explain what's going on and then say why it is actually rather important. Boris Johnson has resigned as Prime Minister, except he hasn't really resigned yet. He's going to stay in place and stay in power and keep running the party for another couple of months until there's a leadership election where the Tory party, the Conservative Party, will elect a brand new Prime Minister for the United Kingdom. Now, there are a few frontrunners here. There is Rishi Sunak, Liz Truss, there's Sajid Javid. They seem to be the ones who are most likely going to be at the forefront of the next leadership election. There are a few other people like Steve Baker or Tom Tugendhat, who I personally would like to see, but that is a little bit unlikely. Now, in general, British markets seem to like this news. Boris Johnson has been embroiled in turmoil for a long time, and this is likely seen as a final opportunity to get past that and to move on, and so that the government can concentrate on governing the country as opposed to fighting off scandals. Boris was also pushing the Conservative Party and the country in general in a high tax, high spending direction, which isn't very conservative for a conservative government. Rishi Sunak and Sajid Javid, on the other hand, have both indicated that they don't like that. They didn't like the direction it's going in, and should they be put in a position to decide to change what happens, they're going to revert back to conservative roots, drop taxes and drop government spending, and sort of let free market economics take hold again once more. Now, right off the bat, this isn't really hugely impactful for American equities. There are bigger things at play for you, like the Federal Reserve and inflation, but it is rather big for British equities right now, and it's also going to have wide-ranging impacts on other things as well. There's a spat between the UK and the EU right now regarding the withdrawal agreement and the whole Northern Ireland affair. Depending on who becomes the next PM, that may take a positive turn or a worse turn. It could be that relations between the EU and Britain get worse and maybe the trade deal stops working. Of course, there's also still loads of tensions regarding Russia and the West, and a new British Prime Minister might get more aggressive, they might get less aggressive, they might push for more sanctions against Russia or less sanctions. It's hard to say at this point because we don't know who's going to be PM, but either way, this really could influence the way that the West as a whole deals with Russia. It could change how many sanctions are in place, whether or not they remain in place into the future. And so this could have wide-ranging consequences and effects that hit everything from equity markets to commodity prices. Now, we'll finish off today with a little bit of corporate news. We have, of course, first, Samsung's earnings for Q2 of 2022, and they actually came out with a pretty strong result. They saw 22% year-over-year revenue growth, which is really quite nice. They saw an operating profit increase of 12% year-over-year again, and that's also really quite nice. There was a lot of fear that they were going to have a really poor earnings report and that this would reflect on the entire semiconductor industry as a whole. So everyone was sort of watching this, trying to determine what direction the markets and this industry in particular is going to go in. Samsung share price is up almost 4% for the day itself. And because it's seen as sort of a bellwether for this industry, for other companies like Taiwan Semiconductors, well, other chip manufacturers followed in a similar fashion. Taiwan Semiconductors rose by 5% on this good Samsung news because it's just a strong sign for the industry as a whole, and so investors are a little bit happy. But let's not get it twisted. All of these semiconductor stocks are still down massively for the year by about 30% on average, and that probably isn't going to turn around anytime soon. They're still all suffering from falling demand and higher costs, as well as just a tougher macro and monetary environment to operate within. Finally, then, we got a little bit of news coming out of Microsoft regarding one of the executives who runs Microsoft Azure, which is their cloud computing part of the business. Now, in short, what's happened is he's been accused of some verbal abuse allegations. Maybe he was shouting at staff, maybe he was a little bit too rough in his leadership style. We don't really know. But anyway, he's leaving the company, he's leaving this district, this part of Microsoft in particular. And this is a little bit worrying for Microsoft shareholders because Microsoft Azure is insanely successful, ridiculously profitable. This is cloud computing. This is like Amazon Web Servers, and it's just a very valuable industry to be in at the moment. And this is an executive who helped to build and create this entire branch of the company. He's worked there for 21 years, and so this is likely a major loss, and Microsoft are going to be scrambling to try and replace him with someone suitable who's able to continue to bring Microsoft Azure to the forefront of this industry. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.